welcome back. Welcome back, everybody, to another episode of, an educational segment with the Cryptoverse DAO. Today, we're going to be looking at more trading stuff, more technical analyses type of information. You know, last week or last episode, we took a look at what a technical analysis is, how to kind of break down a chart, you know, why it's important to run a technical analysis of chart data, how it can help you to make better, more informed moves with your money in the Forex and crypto spaces. And we're going to continue that theme today. If you're catching this on YouTube, do remember to subscribe. Hit that bell notification as well, because we drop so much content, literally education, news breakdowns, sauce sessions, AMAs, whatever it is, anything that happens on our Discord with our community, with the Cryptoverse DAO community. It's most likely going to be packaged and uploaded, put into the relevant kind of like playlist. So depending on what you want, you know, you will be alerted every time we upload. So, you know, you get that notification on your phone. Hey, Cryptoverse DAO just uploaded a new educational short. Just tap the button, boom, you're there. If you enjoy the content we're putting out, do leave a like. If you don't, drop a comment. Let us know what we can improve. Or drop a dislike, actually. Fuck it, why not? You know, play around with the algorithm a little bit. Don't actually do that, please. If you're catching this live, welcome. Thank you for being a part of it. Let's roll right into it. So, moving averages, what are they? If you hark back to the last time we spoke about technicals, I told you about indicators, what an indicator is. There's you know, chart analysis, which is kind of like the analog. I've actually pulled up a chart here for you. Blank, fresh, beautiful chart. This one right here is the British pound against the Japanese yen. This is a currency pair that I quite enjoy trading, to be honest. It's really, really interesting, follows its own rules quite a lot. Now, this right here, what you're looking at, this is the primary sort of tool, or I should say platform, that traders use to gauge price information or index information over time. This is called TradingView. It's brilliant. It's really, really useful. Go to tradingview.com, get yourself set up with an account, and get used to these tools, right? I think we will do a basic kind of intro to TradingView and how to use that. This is, again, community, value for the community. I've spoken to a couple of our community members personally, and they have requested that we kind of explain, because there are, you know, people who are transitioning into crypto and Forex trading for the very first time. They've expressed how important, well, not important, but how useful it would be to have kind of like a introduction or a tutorial on how to use TradingView. So do stay tuned. We will be releasing one of those videos soon. But for now, I'd like to keep it focused on moving averages. So what is a moving average? Well, quite simply, a moving average is, you see this chart, you see the shapes that it takes. A moving average effectively compiles the data of price motion over time, and presents it in a really, really uniform sort of way. It smooths out price fluctuations so that a trader can kind of read what direction price action is going, right? That's kind of like a high-level overview. So with that out of the way, let's take a look back at the Medium article. This is another thing you might find interesting. You know, you can follow, you can click this button over here, and you'll get an email directly in your inbox. So you don't need to join up the live sessions, or, you know, wait until 8:30 UK time or 5 o'clock in America and this time in Antarctica and this, that, and the other. It gets a bit confusing. Just hit that button whenever we're live, boom. Whenever the article is live, you'll get it direct in your inbox. You can read it when you want, when you're out on a walk, or when you're taking a shit, or when you're driving. But maybe not when you're driving, don't do that. But digest this information at your own pace, basically. So what is a moving average? In statistics, a moving average is a calculation used to analyze data points by creating a series of averages of different subsets of the full data set. Right? In finance, a moving average is a stock indicator. That's the one we're focused on a little bit more. I think this is the kind of formula, right? For statistics. If you're like a mathematician, if you studied math at university, this is kind of like a simple concept that you've probably used a bunch of times. But in terms of trading, stock indicator. And remember the definition of a stock indicator from last time, guys. It is a it's kind of like, you know what, put it in the comments. What is the difference between chart analysis and an indicator? What are the two, like, why are they different? Using a indicator and using charting, basically. Now, the reason for calculating the moving average of stock is, like I said, to help smooth out the price data, right? Reduce fluctuations by creating a constantly updated average price, which is then visualized as a kind of superimposed line, basically, that follows, motion. We'll get into that a little bit more later. By calculating the moving average, the impacts of random short-term fluctuations on the price of a stock over a specified time frame are mitigated. A moving average is a stock indicator that's commonly used in technical analysis. The reason for calculating the moving average of stock, yep, makes sense. Let's get into the nitty-gritty of it. Why not? So the way that indicators work, this is a good thing to kind of know. You press this button up here that says indicators. You can have your scripts that are saved, all of this stuff, and you can favorite things as well. So let's type in moving average, right? This is a standard moving average. Okay, I haven't upgraded. Let me remove the exponential moving average. Let's let's take a look at the simple moving average. There you go. Very basically, this is what a moving average is. Now, once you've added this to your chart, you can tweak the settings, obviously. There's the time frame, right? And there's the length. What you can do, basically, is decide what period you want to kind of pluck the data from, if that makes sense. Like short-term averages could be, you could say, like a day chart or a week chart or something like that. You could go for intermediate or advanced, sort of not advanced, but like long time frames as well to gauge data. It's really dependent on your style of trading and what it is you're setting out to achieve with your trading. But in essence, yeah, it's basically just a smoothed out representation of price action over time. Let's go to a week chart. See, this is something interesting as well. With the moving averages, it can be a really good way to gauge whether you're looking at a buy signal or a sell signal, right? And how would we do that? Let's take an example, right? So if the price kind of breaks down, if it breaks the moving average in a direction, that's generally thought of as an indicator for either a buy or a sell signal. So here, for example, yeah, the price, am I on Heikinashi? No, I'm on normal candles, right? So the price hit the moving average, kind of bounced, it broke through it. That's an example of, let's cover it here. I'm pretty sure it's been, yeah, a rising or a falling moving average against price. A rising one indicates that the security is in an uptrend, right? And if the moving average is declining, what does that show you? It shows you that you are in a downtrend, right? Average prices. This right here, that's a bit of a fluctuation, right? It's moving away from the moving average over time. Very simple. Now, you can get into exponential moving averages and this, that, and the other, and I think we will. We'll get into the difference between an exponential and a simple moving average in just a second. But what you should know, right, basic overview, it's a visual representation as an indicator of average price motion over time. And that changes, the visualization changes dependent on the time period that you set. It depends on the parameters that you set. The most common time periods used in moving averages are 15 to 200 days, 15, 20, 30 days, 50 days, 100 days, and 200 days. The shorter the time span used to create the average, the more sensitive it will be to price changes. The longer, the less sensitive. So the more average, I suppose, or the more smoothed out. Here it is as well. The longer the time period for the moving average, the greater the lag. And that's something to bear in mind as well. This is not a predictor of price. This is not a predictor of price action at all. What this is a representation of price action. It's a manifestation. These can lag. These can literally, they will tell you what the price has done after the fact, right? So it's not a case of just, let me wait, like this is going to cross and then the thing happens. It's kind of showing you the average direction of the trend. Now you use that data in addition to data that you get from other indicators about volume, about whether we're in a bull market or a bear market, right? And you use additional sort of, those trend lines that we talked about. You can build trend lines, use, decide what sort of, if you look at the previous episode, there was a really, really great chart full of kind of patterns, chart patterns. You can use trend lines to gauge chart patterns, and you can also use indicators such as the moving average, basically to fortify your position before you enter, before you take it. So yeah, we've covered that. Investors may choose different time periods of varying lengths to calculate moving averages based on their trading objectives. Like I said, yeah, shorter ones are typically used for short-term trading, and long-term, shot in the dark, I'm gonna guess long-term investors, yeah, boom, there you go. There's no correct time frame to use. Again, this is something that's very important. We've covered this in that educational episode about building trading mindsets. There's no correct time frame. There's no wrong time frame to use. There's no time frame you shouldn't use. There's no indicator you shouldn't use or should use specifically. Different indicators are more effective for different things. Different mixes of different indicators are more effective for different things. And there's, the most important thing, to be honest, is to figure out what you want from trading. Do you want to become a millionaire overnight? Like, okay, sure. Figure that out. Figure out a trading plan around that plan. Do you want to buy a stock and long it over like a period of months? Fantastic. Just write out a plan and stick to that plan. Figure out a trading strategy around your plan. But the first step is a trading plan. Step 1, trading plan. Second step, strategy that's in line with that plan. Third step, mental fortitude. Fourth step, execution, right? That's basically, I would say, the smartest way to go about things. Predicting trends, yeah, it's no simple process. It's impossible to predict the future movement of a specific stock correctly, accurately. But using technical analysis and research, fundamentals and technicals, basically, once again, fundamentals is just the stuff happening around the markets. Go on Forex Factory. What is the news telling you? Is it a bunch of red envelope files or yellow files? Is it things you should worry about, shouldn't worry about? Read it, figure it out. Think about what it could do to the value of the stock that you are looking at trading. So now that that's all kind of covered, I'd say let's take a look at the difference between a simple and a exponential moving average. And in order to kind of visualize this for you, I'm going to put a average, exponential moving average against, there you go. Let's take a look. Yeah, it's the same length. Yeah, same length, but you see a difference. Let me just make this a bit easier by changing the color. Let's make that one red or white or yellow. I don't know. Yeah, yellow. Why not? Why not? So same time frame, but what's the difference? What is it that you see? What is it that you see? Yellow one's the exponential one. This one's the simple one. What's the exponential one doing that the simple one is not doing? Right? You see the difference over there? You see the spaces? Let's break down why that happens. So a simple moving average is the simplest form of a moving average, right? This is calculated by taking the arithmetic mean of a given set of values over a specific or specified period of time. In other words, a set of numbers, which in this case would be the price, added together and then divided by the number of prices in the set. You guys remember this from basic arithmetic in like elementary, well, maybe not elementary, like high school, I don't know, in school, right? Basic arithmetic, medians and means and averages and stuff like that. This is basically what it is. You take the arithmetic mean over time. So n would be time. Average period, A is average in period, right? So average 1, average 2, however many averages you want to take, right? divided by the number of time periods you're taking a look at. This is the formula, basically. An exponential moving average is a little bit more complicated, right? Take a look at this and take a look at that. This one is just the number of averages divided by the number of time frames, the number of time periods, excuse me. And this one is a type of moving average that gives more weight to recent prices. So what you do is first, you compute the simple moving average, right? After you've completed this equation, we're kind of getting into mathematics, which I hate it, but it's fine. It's whatever. These are simple moving averages. Once you've got the simple moving average, you take that, you plug it into this equation. You compute the simple moving average over a time period, then calculate the multiplier for weighting the exponential moving average. This is also referred to as the smoothing factor. And that's quite important because, once again, what is it that you see happening? You see more smoothing, right? Which typically follows the formula 2 divided by the selected time period, right? Plus 1. So, for a 20-day moving average, as an example, the multiplier would be 2 divided by 20, which is, again, the period, selected time period, plus 1. And that's equal to this right here, 0.0952. You then use the smoothing factor combined with the previous EMA to arrive at the current EMA value. So basically what it means is it gives recent prices a heavier or higher weighting, while the SMA assigns equal weighting to all values. An exponential, very, very, very basically, the exponential moving average is a slightly better indicator. It's a slightly better indicator because you know how a moving average cuts out price fluctuation? This one kind of does the same. It achieves the same task. It gives more weight to the price direction, right? The direction that you're kind of not predicting, but indicating visually is going to look a lot stronger. It's a much stronger a much stronger it holds more value in fortifying your position, if that makes sense. It puts more emphasis on the recent data points, and because of this, EMA is considered a weighted average calculation. Let's take a look at the figure below. The number of time periods used in each average is identical. 15 is the time period. Okay, wait, week 1, 5 days. Let's take a look at this. EMA responds more quickly to the changing prices than the SMA. You can also observe in the figure that the EMA has a higher value when the price is rising than the SMA, and it falls faster than the SMA when the price is declining. This responsiveness to price changes is the main reason that some traders prefer to use the EMA over the SMA. It's more sensitive, basically. It's more sensitive, and thereby it gives you a better indication of trend direction, right? The moving average is calculated differently depending on the type, SMA or EMA. I don't know what figure specifically is, because it's not identical time periods, is it? Oh, okay, no, it is. Okay, that's fine. Price over 15 days. The moving average is calculated differently depending on the type. This is a SMA of a security. So week 1, 20, 22, 24, 25, 23. A 10-day moving average would average out the closing prices for the first 10 days as the first data point. The next data point after that would drop the earliest price, add the price on day 11, and then make the average out of that. A Bollinger Band. Okay, that's a technical indicator. This specific technical indicator, it has bands, right? Generally placed 2 standard deviations away from an SMA. In general, a move towards the upper band suggests the asset is becoming overbought, while a move close to the lower band suggests the opposite. That's basically, you can do this. It's kind of like a similar thing you do with like a relative strength index. It's effectively, imagine this chart superimposed into, let me see if I can do that actually, maybe pin it to, all right, let's add some bands to it. How do I add bands to it? Okay, I can't on this one, or I'm not sure how to, but basically, let's just do a line, actually. Let's just do it simple, very simple. No, let's not do a trend line. What am I doing? I'm not a very frequent trader, so bear with me, guys. Is it in here? Here? Is it a ray that I'm looking for? Oh, it's a horizontal line. There it is. Man, I'm fucking blind, bro. So let's say like 160, right? That's one band, and let's do another band down at, where is it? Horizontal line. Another band down like here. That's like an average point, right? Let's move that down to like there. Okay, so this is kind of what it would look like. If the price action is down below the bands we were talking about before, like here, as an example, this isn't the best way to do it. This is just a very rough kind of representation, because I'd rather kind of give you guys a visual, because this is a lot of words, bro. This is a lot of words. And there's like a breakdown of like arithmetic on here as well, which is not, I mean, it's important to understand the kind of workings behind these things, but it's also important to visualize things so that you can use them, rather than, you know, just being overly inundated with you know, just technical information. So effectively with this, what you would see is it breaking above the upper band, which is usually an indication that the market is overbought, right? Which means it needs to kind of come down. Some people use this. I personally use this as on like a relative strength index, a similar thing, to gauge kind of how likely the price is to start falling, or to stop, to start going back down, or to start going back up. What I'll do is I will have multiple time frames. I'll have like a 3-minute chart. Well, I might even go down to freaking like second charts, but like a 1 minute, right? A 3-minute super. You can do that here. This button up here, you can put 2 charts on one. Okay, not on the basic plan, but you can, if you upgrade, you can have multiple charts. You can even have them look like this down here. You see, you can have like 1, 2, 3, 4 on one. You can have one big one and 4 mini ones down here. Endless. Literally, there's so much you can do with this stuff. So what I will do is I'll have like a 1 minute time frame with, you know, overbought and oversold, and I'll kind of use that to figure out how likely the price is to start moving. Because on the 1 minute, you see oversold and overbought all the freaking time, man. All the like literally all the time. But if you see it on the 3 minutes as well, right? See the same thing on the 3 minutes. If it's broken above and it needs to come down, what I'll do is I'll go to the 15 minutes next, and I'll see, oh, okay, is it hovering below and it's about to break up? Okay, so the 1 minute says that it's going to, let's say the 15 minutes says that it's like way oversold. The 5-minute chart could tell you that it's about to start breaking up in that direction, but the 1 minute could tell you that it's overbought, right? It could tell you that. And what does that show you? It shows you that eventually the price is going to start moving up for a buy, but it's not immediate. So I wouldn't immediately enter. But it's just little stuff like that, man. You can use so much data. And the moving average is kind of like a very simple but super powerful tool. Because, you know, what you can do is you can superimpose multiple moving averages as well. Because that's what you really do, man. You take data, you create averages of the data, and you use the data to kind of react correctly to price action. You can't predict price. It's impossible to predict price. What you can do is react correctly to it. And how the reaction that you decide on, whether to take a long or a short position, basically, or to not trade at all because you're in a ranging market, it's fortified by that information. It's more likely to be accurate, your call, if you use data, if you use indicators correctly. So yeah, we've covered what it is. We've covered how to put one on your chart. Basically, just hit indicator, type in moving average, and save it as well. Put it on your favorites. I've shown you how to, you click over here, this little cog, and that's how you change all of the parameters of it. You click here, you can move it to the existing pane above, put it on your chart, or you can put it to a pane below. which is, kind of a nice way to visualize things for me. Or you can have multiple. You can have one of this and an exponential one, both on the chart at the same time. And you can use those as kind of support and resistances as well. Because if the price breaks from below to above, that's a buy indicator. If it breaks from above to below, it's, that's an indicator as well. If it touches and bounces, there's endless uses for these, and it really depends on who you are as a person, what type of trader you are, how you would use them. Generally, technical analysts will use moving averages to detect whether a change in momentum is occurring for a security. Whether a change in momentum is happening, that's what it is. Such as if there's a sudden downward move in a price. Is it just a pullback, a fluctuation, manipulation? Or is it in line with the moving average, right? Does it make sense or does it not, basically? Other times, they will use moving averages to confirm their suspicions that a change might be underway. For example, if a company's share price rises above its 200-day moving average, that might be taken as a bullish signal. And what are some examples of moving averages? Many different types of moving averages have been developed for use in investing. For example, the exponential, the EMA, type of moving average that gives more weight to recent trading days. This type of moving average might be more useful for short-term traders, for whom historical data might be less relevant. If you're like scalping on a 3-minute chart, you don't really need to know what gold did back in 2010, right? A simple moving average, on the other hand, is calculated by averaging a series of prices while giving equal weight to each of the prices involved. This is a little info graphic thingy, key moving average trend signals, right? With a 5-day EMA, strong momentum if this one holds as a support or resistance. 10-day EMA, what are we looking at? Indicator of a short-term trend. 20-day EMA, reversion to the mean after an extended trend. Yep, makes sense. I'll let you guys go through this in your own time. But yeah, I hope that kind of made sense. There's a lot to it, and we will cover, once again, like I said, that video about, that tutorial, the TradingView tutorial, that will be coming out, so stay tuned. I've been your host, Brooklyn, or Dharma, or whatever you want to call me. Thank you for being a part of the Cryptoverse DAO. Thank you for engaging with another educational segment. Remember to like, remember to subscribe, follow us on Twitter, follow us on Medium. Check out our link tree. It'll be in the description below. You can, decide where you want to engage. I hope you enjoy the rest of your Thursday. Thank you for your time. Bye-bye.